For those of you guys that don't know me, my name is Mike Kehoe. I'm one of the co-founders here at VentureStack. VentureStack exists to help flippers, buy and hold investors, real estate investors find their next off-market deal. Today, I'm interviewing Kevin Cawley with CSSI, Cost Segregation Services Incorporated. They are a firm that specializes in a powerful tax strategy that we're going to go over today called Cost Segregation. Kevin is within the top three, fluctuating from number one salesperson to three salesperson out of 120 sales reps. So he knows his stuff. And so want to just kick off today's call with just introducing Kevin and his services. Thanks for being here, Kev.
Absolutely. Always a pleasure.
Yeah,
thanks, bud. Good to see you.
Yeah, you too. So I want to get right into it. So if you could just tell us, like, what is cost segregation? Is the process of speeding up your depreciation on an asset, right? So just start off super basic. What is depreciation?
Depreciation is kind of, it's a slick term for a loss, right? So every single building, let's say it's a brick apartment complex, the brick is technically falling apart day by day, hour by hour. So when you purchase an asset, they let you depreciate parts and pieces of it. And I was thinking, if you're cool with it, before we get into what I do and specialize in, which is accelerated depreciation, I would show an example of straight line depreciation.
Yeah,
cool.
that would be great. That would be great. So everybody that's listening is most likely a flipper, a buy and hold investor, single family, all the way to large multifamily and also commercial. So yeah, if you could get into what it looks like to own an asset without doing cost segregation and speeding up the depreciation, how that looks if they didn't do anything and they just own an asset.
Very cool. So like I said, before we get into what I do, accelerated depreciation, I want everyone to understand straight line depreciation. And this is important because if you don't have a savvy CPA or don't know about cost seg on your own, you automatically get put into straight line depreciation. So I'm going to show an example here of a property, residential, purchased at 500K. Okay, so let's say I bought residential property, 500K purchase price. The IRS is going to go, Kevin Cawley now needs a depreciation schedule. So every property in the United States has a depreciation schedule. So any investment property, I guess I should say, right? So any investment property is on a depreciation schedule. And the IRS stipulates commercial buildings depreciate over 39 years, residential over 27 and a half years. Going through this, let's say I bought a residential property for 500K. The IRS is going to say, Kevin Cawley needs a schedule. What kind of building is it? It's a residential building. So they're going to take the 500K and they divide it by the asset class. So that's it. This is straight line depreciation. So if you did 500K divided by the residential asset class, that would give me $18,181 in depreciation every single year. So year one, an $18,000 loss, a write-off. Year two, $18,181. Year three, four, all the way up to year 27 and a half for residential, or 39, or up until you sell it. And when you sell it, let's say you bought it from me, Mike, this whole depreciation resets and you get to start over. So,
and so when you buy a property and you don't do cost segregation and really you don't elect to do anything, this is what automatically happens. And this is what your CPA does with whenever you give him, obviously, the details of your property that you own. They'll put it on this just regular schedule of 39 years if it's commercial and 27 and a half if it's residential.
Yeah. And I should have pointed out too. So let's say you purchased for 600K, they'll probably minus 20% for land, right? So land doesn't depreciate. It's important for you guys to know. So they'll take out some portion for land, and then whatever's left over gets divided by 27 and a half. So in this example, land's already taken out, 500K divided by 27 and a half. That's your write-off each and every year. So if you're in the highest federal tax bracket, I know tons of flippers are because, the flips are very profitable. You take that write-off and they multiply it by your tax rate. I use 37% just to assume the worst or best, depending how you look at it, right? Best meaning you're earning a lot of income, so you're paying a lot of tax. But if you did that math, each and every year, just by owning an asset, not by doing any special anything, you get to reduce your income tax by 67.27 each and every year. Okay, that's
okay. So if I owed 67, if I owed 10 grand, I would just take away the 67 and 27 away from that 10 grand.
Yes.
Or 100 grand, whatever. Okay.
Right. Whatever you owe. So that's the power of depreciation. So even just purchasing real estate, not doing cost seg, it's powerful. Right.
Right. That's why we all do it. Right. It's powerful in many ways, and this is just one of those ways.
Right. Right. So 100% agree there. And then if you don't have questions on that, Mike, I'll go into an actual example on a small property that the owner decided to do cost segregation. And I could point out, here's why. And we could go from there.
Yeah, do that.
All right. So this is a client of mine, new client, purchased in January 21. We already minus his land value. So what we're left with is $323,000 actual building cost. Okay. What I'll show you real quick, and I don't want to jump around a lot, but I'll just show you real quick. If he didn't do cost segregation, let me show you right here. Is that big enough?
No, keep going.
I got it. There you go. All right. How's that? Is that big enough?
Yeah. I mean, okay. It should be okay.
Sure. So he purchased for $323,000. If he just did straight line depreciation, here's what happens. Every year, so total depreciation without analysis, he'll get $11,744 write-off. Okay. What we're doing with cost seg, we're taking parts and pieces and components that won't last 27 and a half years. For an example, we'd go through the building and we'd say, hey, the wood trim in this building won't last 27 and a half years. It'll last 5 years. And we'll say, hey, the cabinetry won't last 27 and a half years. It'll last 5 years. And we'd say the small 3 parking spots behind the rental won't last 27 and a half years. It'll last 15 years. So CSSI is one of the most experienced firms. We did 30,000 of these. So we just do an estimate based off studies that were successfully completed. And we use kind of a template in a way just for an estimate, but it's conservative. So you can see here, we're estimating 18% of the total purchase price. Parts and pieces and components could fit in this 5-year category. And we're estimating 2% will fit in this 15-year category. Okay. So if we did that, instead of an $11,744 write-off, we'll get the client a $62,000 write-off year one, right? So you'd have to wait 6 years, or call it 5 years, to attain this write-off. So you take the write-off multiplied by the client's tax rate, and then we just reduced his income tax by $23,000.
Okay.
So back to your example, you owe 50 grand, now you owe 27, right? If you owe 20 grand, now you owe 0 and 3 grand carries forward. And that's
okay. Super powerful. So going back to it, you said it would take 5 or 6 years to get you to that 62,349 if you just use straight line. Whereas this is front loading the depreciation based off of the different pieces of the property that can depreciate that the IRS deems as depreciating faster than others.
Right.
Okay.
And it's true. Most flooring qualifies, right? So if you have carpeting, that gets stepped on every day. Then you got winter. If you live in a climate where winter occurs, it's going to be replaced, right? It just has to be. So everything we put in these 5, 7, and 15-year categories, we're changing from real property to personal property, which qualifies those items to go into bonus depreciation. So before we move on, I'll just say this. Cost segregation is an engineering way to go in a building and we separate all of these parts and pieces and components that won't last the standard 27 and a half or 39. And that's all it is at a very high level.
Yeah, and the way that, and another way to explain it that helps me understand it is the standard way without doing cost segregation. The IRS is depreciating the entire building, the outside, the inside, everything within it over 27 and a half years if it's residential, 39 if it's commercial. So if you don't do anything, they're just depreciating everything all together, right?
Yeah.
And with cost segregation, what you're doing is you're doing an engineered study where it's essentially just taking pictures of the different parts of the house, right? Or the property.
Yeah.
And then an engineer looks at the pictures. They'll determine the different parts and pieces that they see in those pictures that can depreciate faster. And then they're pushing that over a shorter time period so that you can get those tax benefits of from the stuff that's depreciating faster.
Yes. And the reason this is so important right now is President Trump, when he was in office, did the Tax Cuts Jobs Act in 2017. So September 27th, 2017. The way Cost Seg worked before him, anything we put in a 5-year category would depreciate over 5 years. Anything in a 7 category over 7. Anything in a 15 over 15. Now, what he did was said, anything you put in any of these buckets, 5, 7, 15, you're allowed to depreciate 100% today. No need to wait for 15 years.
Right.
That ends January 1st, 2023. It goes from 100%.
Okay, that ends in 2023. Okay.
Yeah. And I don't want to scare anyone. It's not doomsday, but it goes from 100% down to 80%. Okay, so now you get 80% up front,
and then the rest over that 5-year term or 7-year term or whatever it is. Okay, not the end of the world, but definitely something to think about taking advantage of before that.
Yes, yeah.
Okay,
that's the calendar year. So even though, not to get into the weeds, the tax year for 2022 isn't until April 2023. It's got to be bought in the 2022 calendar year to qualify.
2022 calendar year, and then if you buy it in 2022 calendar year, you're okay to take advantage of the 100% bonus, even though it's 2023. You're able to do your taxes in 2023 for 2022. Okay, that makes sense. All right, and then so how does this? So this helps you cash flow, because you guys always are talking about how this helps you increase cash flow, because essentially, if I owed $100,000 and I had $100,000 in bonus depreciation that like mitigated my taxes, and I owned enough property where, I got a benefit of $100,000 bonus depreciation. Essentially, I have that $100,000 for free to go buy other property, grow my business.
Mm-hmm. Yeah. So most people take the newfound cash flow, they'll purchase more property, pay down debt, reinvest in purchase more property, reinvest. Some guys give it to their financial advisors, whatever they want. The whole point of it is to take this money and make money on it. Because like you said, it's, we don't want to say out of thin air, but it almost is. It would take typically 4 to 8 years for you to get the losses we're creating today, just like that.
Right. So one important thing, and I'm sure everybody's thinking like, okay, we're going to do this bonus depreciation, but then on the back end, like it's going to be wildly different, and I'm going to get all this money up front, but over the term of 39, 27 and a half years, when I get a depreciation every single year, will I not get that depreciation anymore because I'm taking all this bonus up front?
Great question. And you know what? I'm going to share again.
Go for it.
We'll just go back. So, and what you guys are seeing, guys, it's a free analysis. What we do is we run these analysis all day, every day at no cost. And that's how we gain a lot of clients. So we just basically say, here's what we could do. Take this back to your tax professional. And if he can fit this into your overall tax plan, we'll do a deal. So what's nice with CSSI, we're not a sales organization, more so educational, right? So my client Scott here, he said, great, let's do it. I want the 23K. I did not let him sign. You got to bring this back. Tax professionals know what you have going on, whether you have stocks or sold stocks, or whether you're a real estate professional, which I'm sure we'll get into or not. But here you go. So back to this page. Let me enlarge it.
Yeah, can you blow it up? Yeah, thank you.
So, Mike, you asked a great question, very common question, which is why this page exists. Guys would always come to me, investors, and say, well, I like the idea of cost seg, but if I do this bonus depreciation, what happens year 2, 3, 4, 5? I have no depreciation and, I'm technically screwed, right? There's nothing to offset any income. So what I want to show you back on this page, is this big enough?
Yeah, I think so.
All right, so we're only taking 18% of the total purchase price and 2%, so call it 20 combined, and we're depreciating 20% of the building completely, right? So what I'd want to show you here is total depreciation without analysis, 11,744.
Okay.
Total depreciation with analysis, year 1, it's much bigger, 73,605. Now, years 2, 3, 4, 5, you still get a write-off each and every year of 93.95. So the difference is year 1,
$2,400.
yes, $2,400. Now, keep in mind that's the write-off. It's not the net income tax. So you
right.
2,400 times 37%, and it's small.
Right. Whatever your tax bracket is, right?
So it's not breaking anyone's bank. Put it that way.
Mm-hmm.
And this is an important page that shows that. So we could say, hey, year 1 on this property, $323,000, we'll get you a write-off of $62,349 over and above your standard write-off. And every year after, you still get a write-off, but like you said, it's $2,400 less. Not a big deal.
Got it. Yeah. So that makes total sense. It's like barely changes it.
Yes. Yep. And I don't know.
And so this makes sense. So what happens when you sell the property? Like, tell me, because I know that there are repercussions. I don't know if that's the right word, but when you sell a property, do you have to pay back?
Yep.
What happens there?
Yeah. So just like when you sell anything in real estate, there's capital gains tax. And then if you did cost seg, there is recapture. So in this example, right, we're going to net the client $23,000. Okay.
Okay.
Let's say he sold year 1, right? Right after we did this, he sold it. He'd probably owe back every penny of this. Okay. What we advise clients is if you're going to do cost seg, this is for buy and hold guys. We want you to hold a minimum of 5 years. What's the reasoning behind that? Is because if you held 5 years at the time of sale, we could assign very little value to the 5-year components. Now, keep in mind, out of this benefit here, majority of it is from the 5-year property. So if you held 5 years and then sold, you could say you'd probably owe half of this back only, but you got 5 years of the use value of all of this. So it's important to take the money. There's no restrictions on what you do with it, but it's to take that taxes that you didn't have to pay, in this case, $23,000, and put it to work for you for when you do sell. You don't care about the recapture because you've made money on that money already.
Right. This is not something for those that are going to take this money and they're going to go on vacation, buy a TV, like things like that. This is for the people that we work with, people like ourselves that are making money on our money. So it's almost like, would you say it's like an interest-free loan from the government?
Yes, that's a great way to put it. They're saying, hey, you'd get this money anyway, right, if you held it this long. But we'll give it to you now. At some point, you're going to pay a portion of it back. If you sell fast, you're going to pay all of it back. But the longer you hold, the less you pay back of this, right?
Right. Is there a point where the recapture is like completely, like there is no recapture?
Well, yeah, just like in a building, you can hold it so long there's no more depreciation. Each thing's different. On a smaller property, like this one for $300,000, if you held it maybe 10 years, I could have ran a recapture schedule, but Scott, my client, is super long-term holder. He didn't care, but I could have showed you if you sold year 1, how much you'd owe back, year 2, year 3, year 4, year 5.
Yeah.
Another call.
So for me, it's like, if I know I'm going to hold it a minimum of 5 years, and what I would do is I would look at that 23,000 and think about how much I could make off of that 23,000. So like I could buy with that 23,000, I could buy an extra, $100,000, $200,000 property, putting 10% down, or two $100,000 properties, something like that. Mm-hmm. Which obviously I can grow from there and keep snowballing. So this makes a ton of sense.
Yep. And then what I was going to point out, so there's a handful of funds I work with. Here's Helios Fund here in Chicago. where we do cost segregation on all of their properties. So for this fund alone, there was 114 apartments before this fund total that we did cost seg on all of them, simply because it allows you to give your investors greater returns. And so depreciation is a huge part now. Given this bonus depreciation, a lot of people are saying, I want to purchase this asset. What's the cash flow? The second most important question, how much depreciation does it throw off? So here's a big.
And okay, go ahead.
No. And I was just going to point out another group I work with. They put it right in their marketing. Hey, we get big returns because we're leveraging cost segregation and operating losses. Right. So we're going to magnify these losses. A lot of groups I work with, their intent to partner with us is to give their investors negative K1s. Right. Cha-ching. So they really like what cost.
So talk more about that.
Yeah. So if you're a passive investor, there's a fund, they're going to buy a large property or a group of properties. And, you put in 50K, 100K. Whatever it may be, we'll do a cost segregation study on that building. We'll go to a larger example here. Give me one sec. And I'll show you. Once the big benefit's created, the net number gets split pro rata, right? So if you put in 50K and you're a 5% owner, let's say, you get 5% of the total benefit created here. So,
okay, so you get 5% of the total loss.
Yes. Yep.
Got it. But then the next question that I have is, and we haven't covered, is if you're not a real estate professional, that would only go against your passive income that you have. Yeah. But if you are a real estate professional, which anybody that's watching this is most likely a real estate professional because I would have sent it to them. It's a huge benefit because it goes against your active income, right?
Yeah. So we'll touch on it briefly for sure. Because I figure anyone you're dealing with, Mike, in your group is a real estate pro. If you're not, right, so you're not a real estate pro, we create this benefit for you. You're only allowed to use these losses against income from your rental. That's it. You can't go outside.
That's if you're not a real estate professional.
Not a real estate. If you are a real estate professional, these losses can go against any of your income, short-term capital gains, long-term. So you still sell some stock.
So a lot of our guys are flippers, and they're high net worth flippers because they're flipping a ton of houses. Sure. And this is an amazing thing if you don't hold property at this time. This is a great reason for you to think about doing that because you're making all of this income, paying massive taxes on it. Whereas you're already in the business, and you already know people that are buying and holding, might as well partner with them or buy an asset, keep it yourself so that you can take advantage of this cost segregation study and get more cash flow for your business so that you can do more flips, buy more buy and hold, those types of things. Yes. It's something that I wouldn't look past if I were you.
Yeah. So, and to that point too, I work with a handful of flippers too. Well, hey, we flipped 7 houses. We made $1 million. They'll take the $1 million, they'll buy something for buy and hold, cost seg it. They pay no tax on their profit that whole year. And now they have a cash flowing asset they're going to hold. So next year they'll do the same thing and the same and the same and the same. And it's a wonderful way to do business and increase your wealth by buying cash flowing assets to hold long term and not pay any tax on it. It sounds too good to be true. People are doing it every day. Totally legal. This is in tax law. There's nothing wrong with it. And I just pulled up this example, Mike. It's a little bigger property. It's $1 million property. Just so your audience knows, my firm will work on properties with a basis as low as $250,000. I personally work on properties that small all the time, up to very large properties. And I brought this up not to brag, but it's to show you we work with very large investors as well. This was a hotel downtown Chicago, Navy Pier. They built it for $118 million. We got the owners a $15 million write-off, which netted ownership $5.56 million in income tax reduction. So that $5 million was split through the 4 partners. Suffice to say, no one's paying income tax. in that group.
Beautiful. Beautiful.
Yeah.
I love it.
Yeah. But yeah, those are the examples I had. So I had two, $350,000 examples. Here's $1 million example. I'll just touch on super briefly to really drill this point home. This client didn't do cost seg. His write-off every year was $27,691. That's it. By doing cost seg, his write-off year one is going to be $233,565. So how long would you have to wait to get that loss? 30, 60, 90, 120, 150, 180, 210, 7 years to get the write-off we're going to give him today. And then every year after, he still gets a write-off, $22,153, which is only $5,000 less. So
wow, that's crazy.
Yeah,
that's awesome.
So the bigger the
let me ask you this: a lot of people that are watching, they might have owned their property like 3 years already. Can they still do cost seg?
Yeah, so you could go back as long as the numbers make sense. So what I try to coach CPA partners of mine and things, when in doubt, have us run an analysis. It's free. The largest property I did was the furthest back I went close to 20 years. I think it was 17 years, but it was on a $30 million development, right? So it was on a 39-year schedule. We went back. We did find a lot of parts and pieces, components that would benefit. And so it was worth it, but put it in perspective. If you owned a $500,000 apartment building for 17 years, I'd still run an analysis, but it would likely show there's not too much meat on the bones.
Okay.
Yes, you can
All
go
right,
back,
sounds good.
Go back 5 years, 7, 10, definitely. And if the numbers show that it makes sense, of course, you could go back as far as the numbers make sense, put it that way.
Okay. So it's a free analysis. Take advantage of it. Take advantage of Kevin. Have him do the analysis for you. And if it makes sense, you can move forward. If not, then obviously don't.
Mm-hmm.
Okay. And then in regards to, so how does this process work? Because a lot of people are asking okay, can you talk about it from start to finish, doing this study, working with your CPA, that type of thing?
Sure. Yeah. So start as always, guys, go, hey, I've read about it. Can you answer some questions for me? So again, back to being more of an educational role. I explain what it is, how it works. And really what I tell guys all the time, if that makes sense to you, why don't you let me run the numbers? It's totally free. And so once they get some very basic data points from a prospective client, and really here's the data points. What's the address? What kind of property is it? When did you buy it? How much did you pay for it? And did you put any money into it? So 5 data points. With those, we could run a full 10-page engineering grade analysis. That's what we just went through, a couple examples there. And from there, what I do is tell my prospective clients, yes, the numbers are compelling. I know you want to sign today, but bring it back to your tax advisor, right? Because they know everything they have going on in business. And if he gives you the go-ahead, let's do a deal. So that happens more times than not. We get paperwork signed. Basically, next steps are very simple. We ask the prospective client or the client now, hey, we're going to need a couple of things to move this project from data collection to the study phase. That's when we actually ship all the data to the engineers. Someone from our team, again, we're a nationwide company, will have to go visit the property. We do a site visit. So we take pictures documenting the interior and exterior finishes, as well as the building's systems. So it's important to see the HVAC system, the electrical system, the plumbing, etc. Then we'll ask for an appraisal if an appraisal is done. And if there was, great. If there wasn't, it's okay. It's not a deal breaker. And then the only other thing the client owes us is if they did any improvements, we'd want to see how much did you spend total. So they'd say, Kev, I spent $50K total. Great. How was that allocated? And so they got to send us, hey, 25 grand was the roof, 10K to new cabinets, the remainder to fixtures or whatever. And so once we have those 3 things, appraisal, site visit, and improvement cost done, it ships to engineering. It is a process, so it's called the Cost Seg study. Currently, we're on 6-week timeline, start to finish. So you do need some time to plan. But once that's completed, our CEO stamps these things. It's basically our head engineer. We provide the report to the client and the CPA. No extra work for the CPA. He basically takes all of these items that we put on the depreciation schedule now, copies them onto the tax return, and that's it. These reports are just for your own records. They don't get set into the IRS or anything.
Okay. And then is this something that every CPA knows about?
No. So CPAs are my largest partners. I focus a lot of time educating them, getting them up to speed with this Tax Cuts Jobs Act and are your clients real estate professionals? A lot of guys that can have a high earner W-2 guy who may earn $500,000 a year and he owns a couple properties, but it doesn't make him a real estate pro. So I educate them on that. You would be surprised that it's not something taught, when CPAs are going through college. It's not taught in accounting.
Right.
And it is an engineer.
Yeah, So CPAs are trained to take the numbers that you give them and put them into their system and do your tax returns. They're not trained necessarily to lower your tax burden. Sure. And what I found is, and I originally thought that that's what they were supposed to do. They were supposed to help you lower your tax burden every way possible. They can in certain ways, but their real specialty is in doing your taxes. You need to reach out to specialists that do, cost segregation, other strategies, and work with them to get the information to give to your tax professional if you want to pay, little amount of taxes as possible.
Right. And some CPAs are turning around. They're understanding that they're going to have to be more proactive to hold on to clients.
Right. Yeah.
I've seen many times where guys, why didn't my CPA tell me this? He gets so mad. I always vie for the CPA by saying, hey, this is not something he should know. You're the real estate guy. It's your business. You should learn about it and and it's not his fault, so to speak.
Right. Yeah. No, for sure. So why CSSI? Why your company?
So I'm lucky I fell here. It's the only group I've ever worked for. Again, they are the most experienced firm in the country. We've done 30,000 studies, all successfully nationwide in every state in the United States, which is great. Other firms are out there. Truthfully, there's not much competition. I've probably in 7 years went up against other firms 5 or 6 times. That's it. So we're swimming in a blue ocean. But the firm's big enough where, let's say a client goes, hey, I can't wait 6 weeks. I need it done in 4. We can expedite for guys. We leverage our team very well. I think we have up to now 16 full-time engineers, CPA on staff to make sure, this stuff is done correctly. So it's a good workflow of, all right, here's the analyst who did some work. Here's Kevin's files he sent in. The engineer did it. And then a review process. Much like an accounting firm or a law firm where a bunch of people do the work and the head guy will check it all out and give the thumbs up on it. So why CSSI fell here, but now I would never leave simply because I've learned they have a great reputation nationwide. People really we're not trained like a sales organization, meaning, hey, Mike, if you sign today, I'll take off $500. It's none of that crap, so to speak. And we have a large team. So it's great that, other groups, if you got a small team of 8, they're going to have to fly out to see a property in Arizona. I call the Arizona guys and say, hey, can you come visit this property? Same in New York, Florida, and all over the country. So that helps us streamline it a bit.
Okay, great. So what if someone wants to move forward, how do they contact you? And what's the fee structure? How does that work?
Got this domain for $7. Cost Seg Kev, of course. CSI's company. Here's my cell.
Okay.
And then again, my email, I believe it's down there. If it's not, it is Kevin Cawley at Cost Segregation Services. And of course, I could email you this, Mike, but if you want to take a
right, for sure. So if you want to just go to costsegkev.com, that's probably the easiest thing, and then you can go see his contact information. Okay. And then how about pricing for a study?
Cool. So I'll stay on this page. So pricing is determined by a number of factors. Basically the same info we need to run the analysis determines the pricing. So building costs goes into our factoring. When did you buy it, right? So the guy who just purchased will likely get a more benefit. So there might be a higher fee versus the guy who's owned for 7 years and get a lower fee. Building type is a major factor here. So I can tell you from experience, hotels, medical offices get a very large benefit because there's more guts, right? So for medical, there'd be specialty piping for anesthesia or something. Totally different from a self-storage facility, which might get a lower benefit because it's essentially a shell. There's not a lot of pieces and components with a bunch of shells in it. So building costs, when did you buy it? What kind of building is it? Where it's at. So geography has a lot to play into it as well. If you bought a building in Manhattan, the land value is probably through the roof. So we look at all of these things before, while determining prices. So I can't just, we don't do everything we do is fixed fee. We can't take a percentage of the benefit created, but the numbers are so compelling that no one says no to Cost Seg because of the fees. And what I was willing to do today with your group, especially for you putting it together, anyone who has an analysis done and wants to move forward, we could easily give it a 10% discount if you venture in Venture Stack. So in this additional comments,
great.
Yeah, just say, hey, sent by Mike in Venture Stack.
Or if you call, just mention it. All right, awesome, thanks.
Yep.
That's great.
Yeah,
that's great. Okay. Well, yeah, thanks, Kev. We really appreciate it. I think we went over everything. Might have missed a few things, but hopefully it's enough to entice people to reach out to you. You're either paying Kevin and his team a small amount or the government a really large amount. So I would rather call you Kev.
Yeah,
and I think everybody else will too.
Well said there. That's true.
All right, man. Thanks so much. Really appreciate it.
I'm
Have
here
a good
for you.
one.
Thanks, guys.
All right. See ya.